Yeah, so welcome to Lecture 4. Today we'll talk about labor mobility, sort of the counterpart of capital mobility in our sort of vision of factors as being one of the driving forces of European economic integration. So let's get started. We'll review last time labor mobility is, like I said, one driver of this process, but capital was the subject of last week. We talked about some of the reasons that's the case. The lecture today will talk about labor mobility and the interesting thing about labor mobility is there's more friction involved keeping people from moving than in the case of capital. Capital tends to be very quick. We saw at the end of last lecture that capital mobility can cause financial instability, the rise in interest rates in the late 2000 decade, as well as in recent months, is kind of a byproduct of people being able to move assets very quickly. And this is not the case with labor, but labor also follows the money. So we'll talk about migration as an economic decision, as an investment, because once you've paid the fixed cost to move, you want to recover those costs in some economic way in your new future place of residence and work, and therefore it's a human capital decision. So that's an important concept that we learned in other courses. I'm sure you've seen it before. It's not a form of slavery. You're your own slave. You're investing in your own ability to increase your income. So if you take my labor course as a master's student, we talk about that in detail. And as a result, the migration decision may take time, and it may also not reflect the current situation as much as it reflects the future expected situation. And the migration decision affects the individual, of course, but it also has effects that are macroeconomic. So it affects the wage and employment outcomes of the receiving country. It also affects the employment situation in the sending regions. This is true in developing countries as well as in industrial countries. We'll focus on Europe, the European case, but the model we'll learn today, or the models we'll learn today, are relevant for all sorts of contexts. One of the models we'll talk about in detail is the Roy model, which is a way of understanding why people who look identical have different decisions or take different decisions and follow apparently different incentives. Actually, it's usually an artifact of the fact that they know more than we do as economists, as observers. So if you have a friend who decides not to leave Berlin, and you have another friend who has exactly the same education, the same attributes, and this person decides to leave, I mean, why is that? Well, there must be something we can't observe, and if we could observe it, we'd probably observe some self-selection, and the Roy model is about self-selection. And then we'll give you some data at the end about the practical evidence on migration, which is pretty interesting. Some of it's coming from the East-West German situation. There was a lot of migration after the wall came down, as you know, and a lot of people have returned after 20, 30 years. This is all part of this fascinating study of people's behavior in the life cycle. Okay, so a lot of times people come back for reasons that are not exactly pecuniary, or maybe they are pecuniary, but there's something we just can't observe. Briefly, last time we talked about capital mobility. We're talking about the hard stuff. We're talking about the physical capital that helps us produce more goods and services, often accommodated or facilitated by financial markets, but we're really talking about K in the sense of the solo model. And what drives that is basically relative rates of return. And when labor is abundant, wages are usually low, and capital in a nearby region where capital is somewhat abundant will look over there and say, this looks like a good investment. I, the owner, can achieve a higher rate of return at this lower wage, with the consequence of changing the capital labor ratios in both regions. In the aggregate, that means that capital intensity in the sending region will fall, and it will rise in the receiving region. And we think this is a good thing because we're achieving this diagonal that is implied by efficiency in the stripped down case. Okay, we know that banks have a lot to do with this and capital markets. Europe is kind of heavy on the banks and light on the capital markets. That has a lot to do with European history and the Balkanization of European financial matters, but this is changing over time, and I think it's a matter of maybe 20 or 30 years we'll have a real capital union in Europe, and you'll have stock markets that are able to mobilize lots of resources with little regard to national identity, at least on the face of it. But then you have to overcome a lot of political issues that I mentioned at the time. So, you know, the U.S. is fun to look at and learn from, but it may not be the ideal situation. Maybe every country wants to have its own little Chinese wall around it, not to use that term too often, but it is interesting. This is a tendency that just keeps coming back even after many decades of successful globalization, successful internalization of economic relations within the European theater. We still see people raising doubts that this is a good idea. We'll talk about that later on. We talk about economic trade relations. Okay, so just to summarize, the completion of the internal market was part of it. Part of it is the euro. The euro is coming for us later on in the semester. It's already here. It's been here for 20 plus years. The idea of the euro has been around for much more than 30 years. This euro has also accelerated capital mobility. The European Union constitutes the acceptance of a bunch of chapters that involve common regulations of banks. Okay, and now European banks across the continent are basically letting the European Central Bank have a big say in what is a systemic relevant bank, especially if they're part of the European monetary system. And this is for obvious reasons that involve financial stability that we see right now in the United States, even the US with a single currency for a couple of centuries. It's still a problem. It's also a problem, could be a problem in Europe. That's why talking about a banking union at the end of the course is an interesting topic. But again, we're still only talking about real capital, so we're not talking about the banking union yet, but the banking union will help move capital more rapidly than it did, say, 30 or 40 years ago. And we see that. Okay, it's very common for people here in this country to bank with a bank that belongs to Italian capital owners, or at a French bank, or it's common for people in Spain to go to the Deutsche Bank. You know, this is part of this accelerated capital mobility, which is a function of transparent banking and regulations. People trust a common European institution only if it really has some sort of credible stamp on it. Okay, so all this national risk is part of the story as well. So, you know, this could be a course in itself, but it's interesting, important for us to understand the reason why K would move in an Edgeworth box has to do with the shift of ownership, or the movement of the physical capital across a boundary that we just take for granted within Germany. But if you move it from here to Poland, there's always this residual risk. And until we finally establish a common set of agreed upon set of principles, there will always be a little bit of risk involved. Will always be a little bit of friction preventing capital from chasing the higher rate of return. And we see that with the financial crisis. We saw it in 2008 and 9, and the amount of FDI in regions that suffered is still evident. Okay, so a lot of German investment was taking place in Greece and Spain and Italy up until around 2008 or 9, and then in the consequence of the sovereign debt crisis, which had nothing to do with the profitability of productive capital in those regions or the overabundance of capital in this region, but had certainly to do with fear of losing in the transaction. You know, repatriating. Maybe Greece would leave the euro. There was a big discussion of that. Even though we haven't talked about the euro, that's part of the story. So this friction of preventing the arrow from moving, you know, the capital in the right direction is the point we'll talk about. So let's forget capital right now. Let's talk about labor. So labor is the alternative, right? The alternative force of economic integration in our framework. Remember, there are four. One is just being on your own and growing like the other guys. The second one is capital mobility. And the third is labor mobility. The last one is trade, the one everyone thinks about when you think about European integration, right? So let's talk about labor. One of my favorite topics. I'm a person who did labor economics and macro in my career. So labor mobility is a substitute for capital mobility. Just think of those two arrows. They both move towards this diagonal, which in the abstraction means that they both achieve equivalent efficiency. The question is which one moves? Well, Mundell was quite clear on this back in the 1950s. He said these are substitutes. Okay, and if we can get labor to move, that may be very expensive. Maybe capital mobility would be better. And the difference will depend on the path. So the path determines how good an idea this is. Do we really want to have a lot of Polish people come over here? Or maybe we should just move a lot of capital over there. You may be able to achieve a similar outcome, right? And then it's a comparison of adjustment costs. What are those adjustment costs? Anybody have an idea? What are adjustment costs? I talked about the capital case. What are the adjustment costs for labor? Yeah. Yeah, I mean, Europe happens to have like 20,000 languages. I mean, probably 25 in the case, but there are lots of dialects, and a lot of people don't even like to listen to people from Bavaria talk if they come from Prussia, right? Or they don't like to listen to people in Mecklenburg-Vorpommern if they come from Berlin. So these are things that really kind of slow down migration, believe it or not. It's well known, okay? And languages are a big deal. Learning another language is really a large investment, something you do when you're young. That's just one example. There may be some limitation on your activity. You may not be allowed to exercise your profession, right? There may be some regulations say if you're a barber here, you can't go to Poland and cut people's hair. Okay, well, thanks to the EU, that's not the case. But if it is the case, there's going to be an issue because you've invested in your career, invested in your education, it may prevent you. In a world of constant returns of production and all the things we've talked about, these adjustment costs will matter, but they will only determine where you land on the diagonal. They won't determine the long-run efficiency of the outcome. So it's like putting sand in the wheels, of a bicycle. You get a lot of sand in your bike, it's really kind of, you can still go somewhere, but it just requires a lot of energy. Right? So think of these as just two different types of friction, and the one we're going to talk about today are all the frictions that prevent people from moving immediately, right? Just getting up and going. Like everyone gets up and goes to Luxembourg because they pay really high wages there. Do you want to live in Luxembourg? I don't know. I heard it's pretty expensive there, and the people speak a really strange language, which no normal person can understand. So, forget the frictions. Let's stick to the very first Edgeworth box idea. And again, we're talking about the EU. So we're talking about the rich part and the poor part. We're talking about Poland. We're talking about Finland. Often I'll refer to Germany versus Poland because those are pretty interesting interactions we observe now. And we'll just use the simple neoclassical theory quickly to get this out of the way because you know what the answer is, right? It's just kind of putting everything on its head. Now we're looking at the wage as the main driver for migration. And I'm going to show you some evidence in a second, some tables that show how amazingly different wages were in 1990 when the wall fell between Germany, East and West, or between Poland and Germany in 2000, or Bulgaria and Germany, and even now Albania. Has anyone been to Albania as a tourist? It's supposed to be really nice. Beautiful beaches, bunch of pillboxes and anti-tank emplacements, but pretty beautiful place. Wages are really low there, and that's why tourists like to go, because it's cheap, right? So how long can that last? How long did we need before all those Albanians come over here, or the German investors or the French investors put money in those countries? All right, so neoclassical economics is very helpful to give us the basic story, the benchmark story, right? Again, we're starting here. We looked at capital mobility last time. Now we're going to look at labor mobility. Okay, so again, we're moving in this direction. As it stands, Finland is going to be absorbing these Polish people who's coming over to get great wages for their labor, right? That's the idea, right? So, this all assumes that people have a job when they get there. So this is, again, economics and economic models are about understanding the assumptions and being able to critically write them down, admit that you've made them, not fight ideologically, but I assumed full employment for a reason. It makes my life easier. But in fact, we know there's unemployment. So we're going to have to deal with that in a second. But let's just start, this model assumes full employment. Every point along that arrow, as I move towards the diagonal, wages are paid, they're representing marginal product. And as long as I'm off the diagonal, wages are different in two regions. So there'll always be some sort of incentive. Something may hold me back, but if there's nothing holding me back, the arrow will continue to point in the eastward direction in this picture. Okay, so that's easy to understand. But in fact, we have unemployment. So let me get that out of the way, because I kind of wrote my dissertation when I was doing my PhD on unemployment in Europe, so I know a lot about this. I'm not trying to ignore it, but after being here for 30 years, it has gotten a lot better. Unemployment is way down compared to unemployment in 1990 or even in 1987 in France and Germany. So these long-run trends are there, and they're driving the background. So I don't want to ignore unemployment. I just want you to understand we can understand some of the basic thrusts of the model, and then we can come back and talk about unemployment, because market clearing is assuming that everything's fine. Basically, the local labor market in Poland and Finland are clearing at all points in time. The wage is always reflecting marginal product because people are supplying their labor inelastically. The elastic labor supply looks like this. The inelastic labor supply looks like this. Okay? Again, labor markets may not clear immediately, and unemployment would be the outcome of non-clearing labor markets. Okay, so just keep that in mind. So when the wall came down, East German unemployment kind of exploded because a lot of factories were closed, and a lot of people were accelerating their decision to go west. Okay, so unemployment may often intensify the underlying neoclassical assumption and model results that we've got. So we just get that off the table right now. The Edgeworth box ignores that, but it still may be very useful for us because the tendency is still right. Unemployment will often accelerate the situation because, especially in declining regions, looking west is a very attractive option, and if I'm unemployed, it's even more attractive, right? So let's just remind ourselves of the basic stuff you learned in Micro 1. Okay, the downward sloping labor demand curve is simply a reflection of the marginal product of labor, not in the Edgeworth box because that's kind of in the background, but this is what would happen if you took the marginal product of capital in Poland or in Finland and wrote it down. So we'll just take this as being Finland, for example. Okay, so more employment means lower marginal product, lower wages if the supply of labor is inelastic. Okay, so point C would be a market clearing situation, point A would lead to unemployment, and point B would actually be overemployment, excess demand for labor, can't find any workers. Sounds like Germany now, right? All the employers complaining because, can't find any workers, Arbeitskräftemangel, all that kind of stuff. Could reflect the fact that maybe wages are too low. I won't go there, but it's an important possibility. We're just assuming that the market has cleared and wages are such that wage equals marginal product at a unresponsive labor supply. Okay, just assuming people, I'm going to go work 35 hours a week, come hell or high water. But that may not be the case. Okay? So marginal product of labor demand curve, labor supply, inelastic. That's just an assumption. Could well look like this. We could have an elastic or slightly elastic or very elastic supply curve. You can see this one's kind of non-committal. Starts out very elastic and then it kind of gets more and more elastic. That's probably very realistic. So most econometricians would assume that at very, very high rates of labor supply, people just they can't physically work more than, say, 40 hours or 45 hours or 70 hours, depending on the profession, per week. Now, why do I mention that? I mention that because the data do seem to show that although the trends move in the same direction, there are level differences. So, for the past, like I said, for the past 30 years, Europe has had a higher unemployment rate than the United States, on average. If you go to Denmark, it's lower. If you go to Spain, it's higher. And if you take the weighted average of all those countries, you get something like this picture. Okay? So, but the trends are kind of similar. Things are getting better in both regions. And if you look at the employment rate, and that's what really matters, because the employment rate is the fraction of people of working age that are actually in work, they're actually quite similar. US looks much better, Europe looks much better than the United States. In most recent years, it's actually overtaken the United States. And again, why is that? It's because Europe is so interesting. It's so different. Take a look at this picture. So this is the graph, or a figure, that a bar graph that shows the different employment rates across countries. So there's no European story. If you're in a hot place like Spain, you probably don't want to be working a lot. It's probably very, very strenuous. If you're using your hands and your feet to work, it's probably very, very strenuous. So people kind of get out of it when they're ready to enjoy life afterwards. In northern countries, it's not like that, and you have more women working. And southern countries tend to be more patriarchal, and northern European countries tend to be more liberated. Women are sometimes running the show, as you see in governments. So, it's a great, that's what makes Europe so interesting. Okay, but on average, these things are all moving together. You had a question?
Just curious why Japan's employment is so high.
Yeah, it's almost makes you suspicious. Well, there's two reasons. One is Japan has a real demographic problem. So the Japanese just stopped having children a few decades ago, and now they're paying the price for it, better or worse. And the Japanese are healthier, that's another thing. Japanese have a very high life expectancy, and a country that has a high life expectancy has to pay for its retirement system partially by making people work longer. Otherwise, you can't do it. Money doesn't fall from the trees, so in a pay-as-you-go system, the young people are always paying for the older people, so the not-so-young people have to work a little bit longer so they can pay for the older people. Okay, that's another thing. It's also, a lot of people would say that, and this may not be true, but I've heard that the productivity of labor in many service sectors in Japan is rather low. So people are content to be working. It's probably it's got social benefits. You can meet some friends, and if you're 75 years old, you can be a greeter at Walmart. The Japanese have a similar type of store there. They just, it's kind of a social thing. So there may be some labor supply issues that make the labor supply curve in Japan look a bit different from one, say, in Portugal. Okay, so that was my best try at explaining that. But it's really, if you like that, you should go into labor economics. It's a cool area. Any other questions? Yeah, you have a question?
Why does the USA have such a low employment rate for being such a developed economy?
There are a lot of theories about that. It's just average. It's not too bad or too good. It's kind of average. But if you look at the history, it's a great question. So if you look at the time series, this is for 1 year. This is like 2000, it's an average over 2015 to 2019. But if you look at the time series for the United States, it actually reached a peak in the 2000, the Obama years. And then after that, it started to fall. And it's mostly men. It's mostly young men like you. And the question is why? Is it video games? Is it drugs? Is it just, I don't care, I'm just going to, do something else? We don't know. There are a lot of theories about this, and there's a lot of people doing serious research on it. But this is a U.S. problem, a really serious U.S. problem. And it's not even racial. It's like everyone's got this problem. Actually, mostly the good old white standardized American are having the most problems. The African American population has kind of gotten over this, at least females. Right? So I think, again, not the right course to be asking about this, but if you're interested, do a master and take my labor course. Any other questions? Okay, so I should show more pictures like this. You guys get interested when I do that, right? This is in the book, by the way. If you buy the textbook, there's even more stuff like this. But I'm not doing advertisement for my friend Charles Wiplos. Okay, so let's go back to theory and talk about labor mobility in theory. Mobility. So why would somebody move from low capital intensity Poland to high intensity capital intensity Finland? Well, it's an investment. So that's the thing. It's a one-time decision. If you decide to move, you're not at home anymore by construction. So you got to pay for that. So you got to pay for a lot of stuff. You got to pay for a new apartment. You got to pay for your move. You're going to pay non-pecuniary costs. You lose all your friends. You can't speak the language anymore. You have to learn new language. All these things happen. You're still going to be comparing the rate of return of doing the investment and not doing the decision. So there's going to be things like domestic wages, foreign wages. That's what we focus on. But maybe you really want to look at the net wage after taxes. Maybe Finland has really high taxes, which is the case. So if you're coming from a low-tax country, maybe just a naive comparison is not very informative, right? A lot of people, when they compare Germany to Bulgaria, they forget that Germany has a very high social security burden. So, you think you're getting the gross wage, but you're not getting it. You're getting a lot of taxes and social security contributions, which make your life better, but it's not the right comparison. You might get paid a subsidy. So sometimes if you migrate, you get a bonus. You even get money. So these things may happen. In the Edgeworth box, we're going to ignore that. We're just going to compare the wages. And again, the wage in this model that's paid by the firm is going to be something like the marginal product of labor. Okay, so we're going back to the old-fashioned theory, which would just say basically, just like in capital, you go where the money is. You go where the rate of return is higher in capital. In the labor case, you go where the wage is higher, the net wage for you. Okay? So let's start by looking at some data. This is the case. This is the data in 2005. So this wasn't even in 1990 or 1995. In fact, it was so Bulgarians were earning, these are private sector earnings, 5% of the German equivalent. Now, if I was in Bulgaria, I was a skilled worker, I would take off in a second, right? You think, but maybe it's not so easy. In 2005, it wasn't so easy to come over here, right? There were a lot of barriers because Bulgaria wasn't really allowed to send workers over, okay? It wasn't even in the EU yet. Okay, so these are things you have to think. So we have labor mobility in theory. We're going to talk about what happened because people do make it. Some people will come. The rate of return is high enough for working abroad. They will figure out some way to come over. That's kind of what we've learned. It's like a leaky faucet. You can never turn it off completely, right? You break the faucet if you turn it too hard, but it'll always drip a little bit. So this incentive will always be there by comparing the marginal revenue products or the marginal products of labor in both regions. So remember, immigration means that for the holding capital constant, the losing country, the country that loses labor, will see an increase in their capital labor ratio, and immigration means the receiving country will see their capital labor ratio decline. So that means we're moving towards the Edgeworth diagonal. That's a good thing. And if you like the mathematics, you can just make the comparison. This is the expression for the firm's optimality condition, and we know that if little k rises, wages are going to rise. So the interesting thing about this migration is it has two effects. It presses wages down in the receiving region, but it also raises them in the sending region. So Bulgaria, you'll see in a second, actually had an increase in their wages passively because all the good workers left. And this is what happened in Eastern Germany in 1989 and 1990. When the wall came down, a lot of people disappeared from here, and some have never come back. Okay? That means that if you're a firm, what are you going to do? You need labor. So you have to raise wages, and the market outcome is that wages did rise. Of course, there were a lot of other things going on at the same time, but wages going up is a natural process. It's easy to show this using math. So math is like a language to help you understand. Remember output per capita, little y. Okay, that's we got by dividing both sides of the production function by L. Okay? So the payments to capital of a firm operating on its isoquant would be R times capital per unit of labor. Okay? So whatever's left is literally the wage. It's the per capita output after capital has been paid for. Okay? And that's going back to neoclassical economics. In a production function with two factors, if it's not wages, it's got to be return to capital. You can call it profit if you want. There's no such thing as excess profit if you have competition. If there's enough competition out there, basically this is just a way of saying we're moving along the isoquant. So that is the wage. It's y, little y minus k times f prime, the marginal product of capital. So what happens when you change little k? What if you change little k? Then you're going to change the wage. Okay, so if you differentiate that expression with respect to little k, what happens? Well, do it at home. There are three derivative components of that derivative of w with respect to k, and two of them cancel. So what's left is basically the second derivative times little k with a minus sign in front of it, and that thing is positive by assumption. Okay, so wages will rise when the capital per unit of labor rises. That means the wage is going to decline in the receiving region because we're getting more workers. So you can expect the wage in Germany to be slowed down by an influx of Polish workers or Bulgarian workers. Again, this is part of the equilibration process, but you already get the feeling that someone is losing. Okay? And I like capital and labor. Okay? I feel sorry for workers when their wages go down. Just because I feel sorry for them, because they're feeding their families. So again, we have to be honest. One of the consequences of in-migration, ceteris paribus, means my wages go down because somebody else is here and he's also getting a piece of this expanding pie. Okay, it's expanding, so maybe some other things I need to talk about, but if you keep things just on the isoquant, the worker is going to be the loser and capital is the winner. Right? There is a kind of a way of thinking about that. Of course, overall, the GDP of the receiving region will rise, so there's more stuff to hand out to everybody if you can just get it. You have to somehow redistribute. But we know about that. Okay? And this, again, from this expression, you also infer that countries that have low K over L, low levels of little k, will have low wages to start with. So we have all the ingredients we need to understand why the arrow moves from west to east in that picture that I showed you before. So migration raises wages in the sending country and it reduces them in the receiving country. And this means that workers who stick it out in Bulgaria actually are doing okay. Okay, and this is also a well-known story. The workers in the Ukraine who, before the war broke out, were actually doing quite well. And the workers in Poland who have stuck it out and not migrated to Germany are very happy. So migration has two faces always, right? Okay, so again, I've already said this. Capital becomes, less attractive for the labor-rich countries. So the migration, again, acts as a substitute for the FDI coming in. You might think it's better to have the FDI come in. Some people may not think it's so great, but the outcome is comparable for those who are in the region. So you can see that what matters is, in terms of reaching the diagonal, is how fast. How fast does it happen? Right? So within Berlin, East Berlin, West Berlin, a lot of people moved in November, December 1989. A lot of people moved. Still not enough to equilibrate wages. It took a while for that to happen, but it happened. Okay, and then a lot of people went back after a very short time, but most people did stay. We'll see the data later. Okay, so it's a matter of competing adjustment costs. So we're going to spend the rest of the time talking about these adjustment costs. So we can still talk about some of the really disastrous cases. So this is kind of what I like to say is a good case. Some capital, some labor move, and things kind of equalize. And if there aren't too many externalities, everyone's kind of better off. If you can redistribute the gains and losses, but you can also have this happen. So you can actually have a situation where And I told you about this last time. For whatever reasons, capital doesn't follow the rate of return. Okay? So capital is moving in the same direction as labor. So this is what I call a bad case. And this could be because the production functions are fundamentally different. The Edgeworth box is the wrong way of thinking about it. It could be because of a war. Okay, so I'm about to show you the Ukraine as an example. This is what happened to Ukraine. So when I first came here, I said, wow, Ukraine, fantastic, new country, 50 million people. Give those people some capital and we're going to have lots of interesting stuff we can buy, make us all better off, right? Okay, 52 million people in 1990. Capital stock estimated, Heston Summers data set, 8.3 trillion US dollars of 2017. So that's a lot of capital, not as much as the Germans have per capita, but it's a lot. It's a lot more than most of the third world. So if you do the numbers, that's what you get. Okay, so that's a. So what happens after this in the next 30 years? A lot has happened. First, European integration happened with Ukraine. Lots of trade with the European Union, even though they're not a member of the European Union. Europe was interested in engaging, especially German industry was especially interested in getting their hands on Ukrainian steel, Ukrainian coal, oil, resources. Actually, they make a lot of stuff. It's a big country, right? So what happened in the aftermath? Well, 2014, you know, they lost a big chunk of their land. And in the subsequent annexation, they've kind of lost a lot of people as well, and a lot of people migrated. Okay, so 2014, this is UN estimates. We really don't know because there's a lot of forced immigration, repatriation, whatever you want to call it, refugee situation. Okay, and just before the war, we can't get any data now, but 2019, the population is down to 36 million. This is a huge movement of population, and this is not what we're experiencing now, right? This is not what we're experiencing now. This is before the war. So this is economically driven. I mean, Ukraine is one of the greatest places to visit if you like to go to a country that's kind of a swinging country. Go to the Ukraine. There's lots of interesting stuff going on when there's not a war going on. Okay, so I mean, I say this because I've been there a few times, and I really, it's kind of regrettable, but it's the way it is. Look at K over N. Again, using these crude data that I have, you see that it was actually falling. In the meantime, it's rising again under these really pre-war stressful conditions. So I got K over N just literally before the war started. So it's actually gone up because all these people leaving raises the capital labor ratio. It raises the attractiveness of being a worker, and at the same time, you've got to worry about this loss of the absolute capital stock because of the risk of war. Right? So peace is a good thing for business, not a good thing if you're a worker trying to get a job. Okay, so we end up having this kind of situation. And, I just want to make it, I just learned this yesterday. The Ukrainian population in Germany is 9% of the entire foreign population in this country. So this is a huge movement. This is not just a function of the war. This is like a cumulative process, moving that arrow, along that arrow for a long, long time. So to understand all this, we have to think about these things also, because there's a risk of leaving your homeland, there's a risk of not getting a job. We won't talk too much about those things, but you have all these other fixed costs you have to pay. It's a microeconomic decision to migrate, and it's only once. If you migrate, you only pay those costs once, and then you're over there, and then you got to figure out maybe you should come back, and then you got to pay those costs again. Reverse migration. Okay, so let's go through the basics. Investment. It's a one-off decision. What do we know about one-off decisions? If you're a business person, what do you think about when you make a big outlay to start a business? Does it pay? So you're not just thinking about today, you're thinking about tomorrow, the next year, the next 5 or 10 years. Can I amortize the investment? Can I make it worth it? right? So it's a different kind of, you don't do marginal cost equals marginal benefit, really. That's only part of the story, because that may determine the local remuneration for your labor, but it doesn't affect these one-off costs that you have to pay. So it's an investment decision. And this idea of human capital is an old idea. It goes back 50 years to the University of Chicago. Gary Becker, Shastad, and a bunch of other people thought about this a long time ago. And in the meantime, a lot of other very smart people thought about it. So as an investment, you have all these things to think about: risk aversion, and I'm going to try to do this. There are a lot of barriers to mobility. So if you look at the EU situation just in the past, and this is just a few years after accession, you can see that there's a modest, contrary to all your perceptions, the amount of people who live in country X that are not from country X is still pretty small. Europeans put a lot of value on the language. They like where they are, they like the climate, or they don't like the other climate. So again, this really supports this notion that this could be a long-run equilibrium. We don't have to fear, and I have nothing, the only country that really kind of, I won't comment on it. There are several countries where you think maybe there is a little bit of animosity towards foreigners. On average, the evidence may actually support that, because it may be just not so pleasant to live abroad. So this is, again, contributes to these frictions. I'm not saying it's good, it's just part of the cost that you have to overcome if you leave your country forever. And I know this because I did that. I know what it's like to overcome these costs. So if you do this, you need a different diagram. You can't use supply and demand. You have to use an investment decision framework. So this is something you've seen in BWL, if you've taken any BWL course, Betriebswirtschaftslehre, right? Business, how do I make this pay off? Okay, so on the horizontal, you've got the differential, periodic differential I get for migrating. So I get the difference between WF and WH, and WH is my home wage. So it's the opportunity cost of migrating. Stay home. Get the job I have already. Okay, that's the benchmark. But again, you're going to get that every period, and you got to pay some fixed costs. So no matter what you do, if you make a one-day move to another country, you're going to have to pay F. Or if you stay there forever, you're going to have to pay F. And then the question of amortization depends on what? It depends on how long you are going to be working and what kind of interest rate are you discounting with. So those things are in the second term of that valuation equation. So VO is the valuation of an investment, and the O means basically, in this benchmark case, in period 0, what's the decision worth it to me? So I have to pay F in any case, and I get this present discounted value of the differential, because I can always work at home. Okay, so this is the extra topping that's going to make it interesting. It's going to have to be big enough to counteract F, which can be huge. I don't know if you've moved anywhere in your life, we're talking like tens of thousands of euros. And then again, it's also the non-pecuniary stuff, losing your friends, your favorite restaurant, your football club, all those things. Okay, so we're going to use little r to discount it. So I'm intentionally not putting a capital T. So this could be a long time, it could be forever. You're planning for your dynasty, but in any case, this summation is important. Summation over some bounds, and whatever those bounds are, the index T will be the power to which you raise 1 plus r. So far away stuff is not worth so much. Interest rates are low, could be quite a large gain, right? When interest rates are high, then the investment becomes less attractive. Future returns are less attractive. Okay, so what does this do for us? Well, what's the threshold? When do I go? Yeah, I'm going to be looking in the eastward direction, and there's going to be a threshold. It's up there. You see it where the arrow is. So only if this wage gap is big enough, are you going to see me packing my bags and heading out to going west. So this red curve is like the value of the investment. If I tell you, hey, you're free to leave, what is that worth to you? The red is what it's worth to you, because you don't have to leave. If you have to leave, you're going to have to pay F in any case, and it's a losing proposition if wages are not very high abroad. But if they're high enough, it's going to be worth something. So you see, this kink is kind of the value of the investment above the threshold. Okay, and thus, if the wage differential is very low, and I give you this option, you can say, fine, I don't care. It's not worth anything to me. That's like saying the V is worth 0. But if I give you this option, and indeed the wage is high relative to my home wage, then I'm going to be on that upper arm of the bar of the investment, and then I might consider it. Okay? So this is the simple case where I know everything. I know what I'm going to be earning abroad, and I know what the interest rate is. I know what all these things are. So what's an obvious modification of the model? I'm going to try to modify the model and show you how much more friction I can put into this situation, because I've already got a friction. F is like a friction. If you have to pay the government, like in Cuba, sometimes in the old days you had to pay if you emigrate, because you had to pay the government for your education. And East Germany did the same thing. The DDR did the same thing. You can go, but you have to pay us a little bit of money because we trained you. Okay, that would be like F. Okay, but it's true even in a free country where you're free to leave, you still have to pay. So unless your parents are paying for it, you're still going to have to pay for it. And you can actually comparative statics. What happens if your parents pay? F goes down, right? And it becomes more attractive to leave. Just a side point. What other kind of frictions can I put into this model? What else can I toss in there to make it interesting? Yeah. Okay, maybe I don't know. I don't know what I can earn there. So that's we've assumed you know. So that's kind of a cheat. But maybe you don't know exactly what it is. Maybe you just know the average, but there's kind of a range. And if there's a range, then maybe there's uncertainty and maybe you're risk averse. So you discount those uncertain gains with a higher discount rate. So it's like in capital market theory, if the investment's risky, you would apply a higher discount rate just to account for this risk aversion you might have, or the contribution of riskiness to your portfolio. So that would imply a higher discount rate, a lower discount factor, which I'm going to call beta. So beta inverse -1 is this new rate of return, that the benchmark, and it's gone up. So look at the difference. It's gotten flatter. I'm now discounting by a higher rate of return. So as a result, any given differential is less attractive to me. So what do you notice about the threshold? It goes up. So it's even more friction. People are even less willing to migrate. Okay, see? Boop. All right, so the threshold has gone up. So you observe fewer people migrating. What else could you throw in there? Yeah.
Education maybe? Because the education in Germany is much better than in Bulgaria, so you have more incentive.
So for a young person, yeah. So if you're young and you have a higher horizon, a greater horizon to discount the earnings, and then you have the chance to learn because your mind is like a sponge, okay? And so the cost of absorbing the skills might be lower. Yeah, for sure. I'll geschenkt, okay? Young people in general will have higher returns, okay? So for those guys, the line is going to be steeper, the threshold is going to be lower because you have longer time to amortize the investment. So be careful. I mean, it's kind of a negative friction. If you have a bunch of young people, you're going to have a very, very high tendency to migrate. We'll see that with East Germany later. You had a.
Social surroundings?
Yeah.
If you legally can immigrate, doesn't mean that it's easy for you to immigrate even though you have education and money and whatever.
Yeah, I agree. So that would affect F. Probably increase F. I mean, you could also put uncertainty around F. You may not know what things are. You don't know what kind of fixed costs you're going to deal with because you don't really know how sad you're going to be when you get over there and you can't talk to anybody. Now we have internet, we have Zoom, and these frictions have gone down. It's an interesting fact, and I haven't seen anybody doing studies on that, but it is kind of interesting. Yeah.
But it's not really anything you can change with money.
Yeah.
You can learn a language, but you cannot take a course and learn the whole culture and feel more.
Right. Yeah, so it's an open question. So let's focus on the frictions. What is one thing that's really going to make a difference here? I mean, I'm assuming that the WF minus WH is there forever. Now, suppose you're in Bulgaria, you're looking at Germany, and yeah. Yeah, so if things get better at Bulgaria, the gap will shrink. You know, it'll get smaller. So it's not realistic to think this is a constant, because I've assumed here that it's constant forever. That's very unrealistic. So WF minus WH will shrink. And if it does shrink, we can think of WF minus WH as being the current level, okay, which I wrote down there on purpose, but it's shrinking. And if it's shrinking, that means that it's like a higher discount rate, because in the future, you're not going to get the same gap anymore. It's going to be smaller. So it's shrinking as well as, so it's like a type of discounting. So if you do that, look what happens. It gets even more unattractive to migrate. So the expectation that things at home will catch up will hold you back from migrating. Wow. Okay? So we've got all this. I mean, if you're fearful that your home is going to be overrun with immigrants, probably not going to happen, because there's a lot of reasons people aren't going to do this. And if you look at the data, okay, remember we looked at Bulgaria in 2006 it was, I think, or 2000, and it was like 5%, actually it was 5%. Now let's look at a similar measure, not quite the exact same measure, because this is a monthly indicator, which doesn't make too much of a difference actually, but you can see how the convergence has occurred over time. So in 2006, the Bulgarian would have seen 8% of the German equivalent, and by 2018, it was 18%. That's a doubling, more than a doubling of your wage, relative, okay? And Germany is growing, so, okay, so Bulgaria, you're saying, well, I'm still kind of tempted to go, but look at some of these other countries and you see, wow, Poland moves from 26% to 36%. It's gone down a little bit, 32%. Again, you've still got this prospect of, and you've got cost of living. These are just raw comparisons of euro wages. And if you remember the Balassa-Samuelson effect from macroeconomics, high productivity countries have higher costs of services, and that means your life is expensive. So Germany is not cheap. It's not as cheap, it's not as expensive as Denmark, where things are even more, or Sweden, you know, or Norway. So think about it. Maybe Bulgaria, you have a cheaper apartment, bread is cheaper, non-traded goods are cheaper. Still, you see this inexorable convergence. So this is a huge success story for European integration, right? It also means a lot of people are not going to come over because they don't want to. Why should they? It's not just about, like, you know, bean counting comparisons. And if you extend it to the current period, you see things have even gotten better. So this is an update that was just made. You see that Slovenia is now, you know, on its way to becoming like northern Italy, and Romania is doing extremely well. Wow, look at Bulgaria. So Bulgaria is still kind of public. So you can see things are kind of different depending on, you know, is capital coming to Bulgaria or people just leaving Bulgaria? So it's this, you've got this kind of race situation. And remember, within Europe today, Western Europe, there's a lot of gaps. So just between Portugal and Germany and Ireland and Germany, there are gaps. And Germany's not the best place to live nowadays either. I mean, everybody knows that Vienna's the most attractive city in the world. Australia's too far away. And then you've got Copenhagen, Stockholm. And look how expensive it is to produce in Denmark. So, I mean, I think a lot of Germans might be tempted to go over to Denmark. So this is part of these gaps are kind of part of an equilibrium. I don't see people complaining about that. So, and it is getting hard to go to Denmark these days if you want to work there. But anyway, let's move on and talk about the effects on the host country. So neoclassical economics says that, you know, going to change capital intensity. This is going to affect the host country. It's going to affect the target country. Wages will rise in the sending country, and the host country wages will fall. And this means that there's a distributional issue. This is where it gets really tense because, I mean, I like migration because I think it improves efficiency, but obviously there are some people who disagree with me because people protest about this. So maybe there's some public goods that are being crowded out. Maybe there's a problem with tax revenues, paying for the schools and hospitals. These are things that we haven't talked about. Okay, but we won't talk about it yet. I just talk about labor versus capital, the most fundamental distributional issue. Right, so this is what kind of excited me about this thing, because it's the distribution of factors. You've got capital abroad, capital at home. You've got, and again, I'm talking about Germany as a receiving country. Labor abroad and labor at home. These are 4 different players that have different outcomes in this story. Okay, so you should write that down. That's very relevant. Complementary factors tend to profit from immigration. Complementary means I need those guys to make my business work or to make my factor work. And substitutes mean we're competing with each other. So obviously, in the capital labor case, labor from abroad coming here will compete with labor already here. Those are substitutes. But if I'm a capital owner, I'm going to profit from immigration. Okay? So return to the factors that are substitutes tend to fall. If I'm competing with the people from Poland or Bulgaria, my return will fall, my wage. But if I'm a complement, if I own the firm that's hiring those guys, or if I'm a person with a different level of human capital that profits from having them around, I'm better off. So there's always this distributional story. You have to remember that. And this has nothing to do with xenophobia. It's basically understanding the economics. And the way to get around that is to understand that overall, the country that receives the migration will profit. It's always a total GDP improving move to have people come in. But you've got to redistribute the gains to make the losers happy. And that's not so easy. You got to use taxation. You can't just take the immigrants' wages from them. You have to take the capital owners' wages, because those are the guys who are profiting the most from immigration. Good luck, right? So think about it. The political economy of this is difficult. There's a great diagram that's in Baldwin Whiplow's that kind of shows this. This is a classic. Okay, so what I've done here is I've got the labor demand curve at home looking like a labor demand curve that you know from your courses and from other stuff. And then I've flipped the labor demand curve abroad and put them on the same diagram. Okay, so again, marginal product at the same level of labor. Think of capital as being given. So you're just talking about the labor mobility decision. The marginal product of capital and labor are going to be equalized when capital-labor ratio is equal in both countries, or when the wage is equal in both regions or countries. Okay, so that's going to be point Q prime. We start out at point Q in the home country and point Q star in the sending country. So you've got this wage gap, right? So obviously there's going to be a reason for the labor-poor country to be attracting migrants, and the labor-rich region or country will be sending them. So this can't be an equilibrium. At home we've got W, and abroad we've got W star. So you've got this wage gap. And again, go back to your Edgeworth picture, and you know that in the long run, everything should be the same. So we have the same capital-labor ratio, and holding capital constant means we have the same wage in both regions, and we should somehow get there. So who wins and who loses from this action? So we're going to move from the initial situation to the post-migration situation, and the question is who benefits, who loses. We can use this simple picture. We don't have to use a lot of math. We can just use the picture to figure out whose surplus gets evaporated and whose gets expanded by moving these people back and forth. Okay? Okay, so that's why I've got these rectangles and triangles there, so you can see this in complete clarity. All right, so you can see what happens. Wage goes down at home because we've got these migrants coming in. Again, we're Finland. We've received these Poles. The wage has gone down for my Finnish workers from W to W prime. Okay, the wage in Poland has gone from W star to W prime. Same wage in the long run. And you see how in the horizontal axis that you've had some shifting of labor, L minus L prime. That's the mobility involved. So how can we assign the income gains and losses? So pay attention. This is where it gets interesting. This is what the home workers lose because their wage went down. Okay? And then they're different from the guys who came in who are working next to them because they're gaining. They came over here and they had nothing. Otherwise, they wouldn't have come. Okay? So A is the, and you know, it's an income loss, but it's also a gain to the owners of the machines that put these people to work. The owners of the firms that put these people on the bicycles to deliver the food. Okay, so it's a shift, it's a redistribution. Okay, keep that in mind. A lot of people don't like to talk about that, especially if you own the capital and you're hiring the migrants. You don't want to talk about that, right? But if you're hiring someone to come over here to drive an Uber and you own the Uber car, that's a great deal. You needed the labor, now you got the labor. Now B is an efficiency gain that we talked about. That's really that's why we like migration, because it makes us efficient. B is the Harburger triangle. Okay, it's the gain for us. Now look at this, it gets even more interesting. The workers that stayed actually gain as well because their wages go up. And that's like a gift to them. Tschüss, see you later, you know, my wages go up. I'm glad that guy left and I'm still here. Right? That's one way of thinking about it. So the foreign workers that stay actually gain. It's a windfall, just like it was a windfall for the capitalists who hired the immigrants. Right? That's why industry in Germany lobbies for immigration. It's good for them. And economists can see that. You can criticize it, you can praise it, it's great, maybe even efficiency increasing, but we should understand why they do that. Okay, and that's why they do that. There's an efficiency gain as well in D, because we're moving towards a more efficient allocation of labor. So D is a gain to society, if you like. Again, an efficiency gain that we can talk about how we redistribute. Of course, the total gain of migrant workers who go from Poland to Finland is the sum of those two, because the migrant workers gain. They were working at low wages and now they're working at the high wage country, and then you've got this windfall gain to the workers who didn't leave. Okay? So we have two Harburger triangles. That's the net efficiency gain from having this wonderful migration. Are those triangles big? Depends on the slope of the labor demand curve. Okay, so think about that. This is the central analytic tool for thinking about the efficiency aspects of migration. And we know that we're better off if we bring the Bulgarians over and they do something in our society, in our economic system. We'll have more restaurants, we'll have more people driving taxis, we'll have more CEOs, programmers, etc. Right? The question is, can we guarantee that everyone benefits in some uniform way? So that's why having a public sector, having taxation, skimming off some, that's what governments do. They skim, as long as it doesn't go into the politician's pocket, it should go into fixing the streets and building some universities and doing stuff like that. Okay. What if you have unemployment? If you have unemployment, things are a little bit nuanced, okay? Because you can still have migration and people can come in if you have a situation like this. People migrate for a lottery ticket to get a job because there aren't enough jobs, because wages aren't clearing the market. There's a whole model world that's based on that idea, especially in developing countries where the cities have lots of unemployment because a lot of people from the farms come into the cities to get a lottery ticket to get a job. If they get a job, it's a great job. Okay, you have a similar situation in high unemployment regions. If the wage is high, you're going to get crazy. You're going to get more migration. If wages are too low, people will be leaving. Right? In the case of East Germany after the wall came down. Okay, so again, I've talked a lot about the macro. We should really talk about the micro decision, because I don't want to take too much time on this. This is the question of who migrates. So the world is full of different people. It's not just labor. You have high-skilled labor, low-skilled labor, young labor, old labor, you have people who speak many languages, some people only speak one language. So all these things matter for the migration decision. And there's a lot of evidence to that extent. So we say that observable behavior is driven by stuff that we can observe. Maybe we can even measure whether you have language skills. Some things we don't know. Like maybe you have a friend in the receiving region that's going to help you find a job, help you feel better. Maybe you have a whole little community that will take care of you, okay? So these are things that we can't observe. So the issue of natural selection or self-selection is part of the story. Roy talked about this in the context of selecting an occupation. So why do people become dentists rather than professional piano players? You know, there must be some subtle stuff that we can't observe. Usually it's people know themselves better than we do, okay? So people are different, they know more than we do, and there's going to be a distribution of these reasons to migrate. Okay, that was the brilliance of George Borjas, who put this model to work in the migration context, but it's been used since more than 70 years in this to decide why people do things. And the idea is if they've done it, there must be a good reason, and we probably don't know all the reasons. Okay, so it's deep. So let's think about it as a statistical problem. It's basically you have two people, two different people, or one person with two different options. So here you have a person with a distribution of outcomes at home and a distribution of outcomes abroad. That's really what it's all about, because we know that you don't know anything with certainty. Even if they tell you you've got a job, you may not have it. The reason my parents went to the United States was because some American agent was traveling in Eastern Europe and told people 40 acres and a mule in Texas. They said, wow, that sounds pretty good. I hate the Austrian government. Let's get out of here. This is like 1880. So they took off, and there was no mule. There was no 40 acres. There was a lot to do. So that's really incomplete information. The idea of ROI is very simple. You know what you got at home, and if I can look at you and I see your observable characteristics, then I know what you're going to be earning up to a random element. And that random element is the deviation from the mean. And I'm going to assume that's a normal distribution. If I move, I get this other distribution. And you can see that the mean is higher. So if I go over there, I get a draw from a better distribution. But I could also have some bad luck. Okay? What matters in this case? What kind of information would be useful for you if you knew that you had a normal distribution at home and a normal distribution abroad? The standard deviations are important, so you can see that with the spread. But there's one key thing that I haven't mentioned yet, which is, think about it. All I can see is what you do, and this is what you kind of know. But these distributions are conditional on you being in the other place. It depends on the correlation. It's not enough to know that you have these distributions, but maybe if you take a draw from the home distribution and you go to the foreign place and you take a draw, it may be negatively correlated. So the skills that you have or the special aspects that you have might actually be negatively correlated abroad. So if you learn Marxist-Leninism and then you migrate to a country where they have capitalism, your knowledge ain't worth much. Okay? Or if you learn how to be a doctor in a country where your receiving country doesn't recognize your degree. A lot of Israeli taxi drivers in the 1990s were actually Russian immigrants. They were like engineers that couldn't do anything, but they wanted to get out of Russia, and they went to Israel. Okay, so that's an interesting fact. There you have a negative correlation, right? But again, if the distribution is to the right far enough, it may still be worthwhile, because being an engineer in the Soviet Union may not have paid as well as being a taxi driver in Israel. So these are the things that matter. So this is kind of what Roy talks about. It's the spread at home, the spread abroad, and the correlation of the two. That's going to be the drivers of the decision in the Roy model. So this is super basic, and it uses a couple of insights from statistical theory that just show you You're basically, if I know what you're making home, I can kind of predict, and you could predict, if you know the correlation, what your outcome would be if you go abroad. So that's a, suppose you're earning WS, and this is a draw from this distribution on the left, and then you're kind of considering, okay, all these things that matter. One thing is the spread at home. How far am I from the mean of my own home distribution? So I could be far to the left or I could be far to the right. Think of a Cuban baseball player. Okay, the Cubans are really good baseball players. They don't earn very much money at all, so they're going to be on the right to their distribution. If they migrate, depends on the correlation. We know that American baseball players value Cuban baseball players very highly, so the correlation is probably 0.99, and then it puts you into the distribution of the American baseball players, which puts you way to the right. Okay? So it turns out if the normal distribution is okay, if we make that assumption, then there's a nice formal outcome that looks like regression, actually. Okay, it means basically if I know the distance that I have currently from my mean and I know the correlation, I can kind of do a best prediction of what I'll be getting abroad. And it involves something that looks like a regression coefficient. It's a simple formula like this. It's the expected value of the wage in the target country, given that I'm earning WS. It's going to be a sum of two things. It's going to be first the mean of the target plus a correction that's based on how far I am from my home average, controlling for the correlation, which could be negative or positive, and scaled by the standard deviation at home. Yeah.
So wait, but if everyone earns more when they move, why shouldn't everyone move? I'm getting all of that. Why shouldn't you move? So, no.
Yeah, because because we can't observe. First off, even you as a decider can't. You don't know what you're going to get, but you have a good idea. Okay, you know where you are in the distribution at home, and you know what the distribution looks like abroad, and you know the correlation with your position, with your position in this perspective. You could have some bad luck. Okay, clearly there are some baseball players from Cuba that don't make it. Okay, but that's what the correlation coefficient is supposed to capture. It's a tendency. So if I'm just observing these people moving, I could assume that they had this information, and that would kind of predict their decisions. And it's actually a model of individual behavior as well, right? So this model has some very interesting predictions. It means that if I'm below average at home, and the correlation is positive, then I'm probably going to stay home if my distribution is tighter than it is abroad, because if I'm kind of below average here, I don't want to be below average over there where the spread is really high. Okay? So, I mean, this is a really powerful model. So lots of predictions. I write them down for you. You get an idea. I mean, there's several things that matter for migration. Lots of different competing frictions, if you like. Okay, one is all things given, ceteris paribus, as we say. The higher the target region wage on average, the higher migration is going to be likely. Okay, so that's just a general, that's what we already know from the simple neoclassical model. We also know that it's decreasing in the source region wages. So as things get better at home, that's going to decrease the spread. That's kind of common sense. But the variability is what we haven't talked about. Right? The variability given the correlation and variability abroad. If the target wage increases, this is going to increase your probability to migrate if the correlation is positive. Okay, and if you're above. If you're above average. If you're below average, so you have this sort of selection process, which is, we talk about brain drain. This is kind of the brain drain story. It's also decreasing in the variability of the source region wages if the correlation is positive. And it's increasing in your own position in the source distribution if the correlation is positive. So if you're a good Cuban baseball player and you're really good, and the correlation is positive, you're really going to be trying to get into the United States. And that's what we observe. So the very best American baseball players come from Cuba, Dominican Republic, not only, but much more, batting way above their weight class in that respect. Okay? So this Roy model is kind of a wonderful way, and a lot of people have done some serious work on this. people can infer that a lot of people will not migrate, even though they're facing a situation. It's obvious, you have to go, right? Not so. Okay, and these correlations can depend on your age. So, like, you know, if you're older, an older worker, you have different correlation with your prospects abroad because maybe you're less flexible. All these things can matter. Okay, so let's go back to this investment decision for our last point. This is about the so-called option value of waiting. Because when I tell you you can migrate, you might say, well, I don't care, I'm never going to migrate, forget it. But you're kind of ruling out some interesting possibilities. You don't know what's going to happen in the near future. You know, if someone says, I'm going to give you a ticket which allows you to migrate, otherwise the door is shut, I'd keep the ticket. It's the option, right? I may never use it, but it's worth something. Okay, so this is an idea. If you know anything about finance, options, what is an option? There's a real option theory which has to do with real decisions. You know, the idea that maybe it's not so obvious that I'll do this now, but maybe in the future things could change, and I'd like to have that ability to decide in the future. Similarly, it means that maybe in the case of migration, I could migrate, but I could also postpone it. Okay, so I could go back, but maybe not today. And why would you postpone? Well, maybe things will get better, and maybe they'll get better quickly. And if they do get better quickly, I don't want to waste my money moving and then regretting it and coming back. Okay, which happens a lot. We saw this after the unification episode. Okay, this is called the option value of waiting. Okay, this is because we have upfront costs and we have randomness. Okay, you can't recover the fixed costs, but you have the possibility that things may get better, and they may get better in a way that's not reversible. So we have economic growth that usually, unless you have a war, that means that things are going to get better pretty much forever. So if Bulgaria grows faster than Germany for 10 years, that gap has been closed permanently for forever. And that's something you may care about in the sense that waiting and seeing is a good option. So you have this possibility of postponing the decision. And we see this if you do surveys. This is an old survey that I keep showing every year because it shows that a lot of people in very poor countries all say that they think about this all the time, but they don't do it. Otherwise, we'd be swarmed with Albanians. Albania still is populated by Albanians, okay? But back then, they were really interested in, learning about, some people actually came, many went back, okay? But here you could say that in 2000, most Albanians had never been out of the country, okay? So making some sense out of those data, this idea of maybe I'm thinking about it, I'm going to talk to my friends. We have to go back to this picture again. Remember, in a world of certainty, it looked like this. Okay, but it turns out, like I said before, if the wage gap is zero, and I say, I'm going to take away your right to migrate, would you be upset about that? Well, if you live in a world of uncertainty and things can get better, then maybe you would not like to give away your right to migrate. You want to have that option. So the way people in finance think about this is that the investment decision has positive value even if the wage gap is negative. Okay, so this purple is kind of like an extrawurst. It's like an extra value of having this option to migrate because even though an iron, sort of a dead certainty type of perspective would say, don't do it, it's just ridiculous. But in fact, things can change in the future. And if you're giving away this opportunity forever, this could be foreclosing situations that you might care about. So this is called the option value. And it's kind of the difference between the pink and the red is this option value that I'm talking about. Okay, last few minutes I want to talk about labor mobility in practice. I want to show you some pictures. I want to show you East German migration. I'm going to show you within the United States. I'm going to show you the migration patterns in the EU. So East-West Germany is, for me, is like a crucible of studying this process. I mean, 1 million people moved in very, very short time. 1.5 million, I think, in 2 years. The wall came down, just a flood of people. People in Munich were nervous because there were Trabants everywhere. you know? And there was people were nervous. They wanted to have German unification, but hey, not in my backyard. Put it somewhere else. But fact is, millions of people were coming over. It turns out that if you look, this is a time series plot of migration. So you see that before the wall was built, a lot of people were leaving East Germany. That's why they built the wall in the GDR. They stopped it. But some people still made it. 10, 15, 20,000 people per year. And then the wall came down. Look at that, 1989, shoots up. So the integral of that curve, under the curve, is the sum of gross migration over that period. It's huge. And you can see that the migration of west to east also rises. So a lot of these people said, not so great, I'm gonna go back. There were some people from the west who actually, got the Buschzulage, it came over and took a job. And I haven't extended this, but in recent years, it's zero. There's no difference anymore. Okay, so a lot of young people went and then came back when they got older, made some money. A lot of people started businesses with capital they've made. This is kind of an update. You can see that they're pretty much touching each other. Yet for East Germany, this has been a net loss of population. Okay, so whether you consider employment or population, has been a downward trend. Okay, so this is like Ukraine, losing a lot of people. East Germany started with 17 million people, and I think now we've got about 13 and a half million. Yet, this is the process we talked about. I showed this last time. This is the movement towards the Edgeworth diagonal. So if you look at individual East Germans, why did they do it? This is some of my own research. You can see that things that we talk about in this course matter. Okay, so if you look at the data, 1% increase in the wage in the average West German state leads to a 1.7% increase in migration to the target region, and it leads to a reduction of population in the source region by 1.15%. Okay, so wages do matter. So as wages converge, you get less migration. Unemployment matters. Okay, so we talk about pull versus push. Unemployment is push. Unemployment is high, I leave. Okay, unemployment is low, I don't. And the pull would be the wage. It matters how old you are. Okay, so this to me is the most interesting of all. Most of the people who went west were young people. Okay, and as I said, some have come back now and they've bought a house and blah, 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 but older people, not so much. And these are all pretty statistically significant, and they all go in the right direction. The United States is another great example. The United States has a common language, lots of migration, so it's a different situation. Most people who migrate are still young people going to college. After college, they leave the state, okay? And you also have to worry about the people migrate for reasons not just because of money, but like Florida, Disneyland, Arizona, clean air, whatever. Yeah.
What's the age of people coming back from West?
Older. So we have some data on that. You can actually Germans are great with data. Sometimes you have to beg, but the Landes statistic is amazing. So you can get because we have population registry, we know when people move somewhere they have to register their address. So we know most of the people who move back are older, usually 50 or older. I mean, it's just you can make it's a great study, a great topic for a thesis. So in the United States, income matters. This is from Robert Burda. We looked at his picture a couple of weeks ago. States that have high income tend to be pulling people in, and the only exception, of course, is Florida. It's way off the curve just because it's really nice weather there, and you have Disneyland. Okay, so I'll finish up talking about this one. This is Europe. So within European context, Europe is now a receiver of migration from abroad. This was not the case a few years ago. So Europe is a net importer of people. And we kind of expect North America to be like that, but it's interesting to know that Europe was, after World War II, was sending people to the United States and elsewhere. Other parts of the world are net exporters of people. Within the EU, this is, I've not been able to find an updated version of this, but this is just to give you an example of the kind of within EU migration patterns, extraordinary, right? So you have a lot of, this is a really good economic year for migration because you have lots of variability. You see that Southeastern Europe was giving a lot of manpower to Spain because Spain was having a big property boom. They were building lots of buildings and apartments and hotels. And similarly, Poland was sending a lot of people to the UK, not to Germany, because Germans had a barrier to Polish migration, a grandfather clause. So Poland joined, couldn't send migrants until I think it was 2011 or 2012. So Poles still managed to come to Germany under special agreements, Spargelstechen and all that, but most of the people were working in British services. And a lot of people say this is one of the reasons they got Brexit, because they didn't like too many people taking over a town and just, all the shop windows are in Polish. Some people can deal with that, some people can't. But, and Ireland, look at Ireland. Ireland gets a lot of population influx, even though everyone thought Ireland was just, I told you about Ireland, boom country. So you see it right in this picture. Again, optional value of weighting is important, and here's some data. I'll try to update this for the next time. Okay, so next lecture, we shift gears completely, talk about trade. We've talked about moving capital and labor as engines of integration, but now we're going to talk about trade. So how could trade modify this integration message? Can trade help us converge to a common standard of living? You need two goods to trade. You can't trade GDP for GDP. It doesn't make any sense. So we have to expand the model. We have two goods then. So all the stuff we learned before, you're going to have to do it again. I'll give you an introduction to trade theory, but it's only an introduction. If you took Kamika's course, good. If you didn't, it's not going to kill you, but you may have to think a bit more, because why do you trade? Presumably because it makes all of us better off. Not just, I'm not taking stuff from you. You give me something, I get something. Otherwise, I can just keep it. So it turns out that capital and labor have a lot to do with what you trade. So the trade theory I'm going to focus on is one that stresses capital-labor ratios, because we're still in this Edgeworth box, right? And the question is, can you integrate and not have to be on the diagonal? And the answer is yes, it is possible. Not necessarily so, but it's possible. Okay, so we'll talk about the theory of capital and labor endowments, the theoretical role of those two. And that's not the whole story. And you can have trade that has other aspects that can make things worse. So we need to take those things into account as well. Okay, so we learned a lot. I hope you had fun. And have a nice day. It's beautiful weather. See you next week.